Very good evening to all respected viewers and very esteemed faculty of the day. Our own CA Sandeep Shaji, my own chairman, Chairman Research Committee, CA Anuj Goyalji, our special guest of the day, CA Prashant Jhaji, our young member, expert in GST. And today we have a very important topic on which our learned speaker and who was member in past few sealed panel and key person instrumental in developing this award, which was started way back in 1958 and continuing we have a legacy of this award in financial reporting. So, sir, the very purpose of this webinar is to reach the members and to teach the member, and to teach the member that what are the commonly found observation based on past nominations, how we can improve our reporting system in annual accounts, and for both. It's a teaching for the technical viewers also who are supposed to apply their time and their expertise while reviewing these nominations. So it is a good opportunity for all the members, either they are part of any process in finalization of accounts as a practicing member, as a auditor, or as a industry member, as a CFO or kind of thing, or a team of CFO. And third layer is as a technical member. So I think everybody who is in the profession of chartered accountancy, either in form of practice, either in form of industry, or as a technical reviewer or technical person, I think this is the best session which we can say. And it's learning through the mistakes by others. It's a good part, that is learning by mistakes by others. And I am very grateful to my chairman, C. Anuj Goyalji, who is very dynamic. He is a member of all the three institutes. He is a very dynamic person, and he is heading this committee this year again. Last year he was chairman, and before that also he was chairman. He brought various changes in the committee. Very good initiative he has taken, and last year, this whole process, what we did, we received so many observations, the suggestions from the members. And last year, what we did, we spread our technical reviewers panel. We introduced so many new people in the technical reviewer panel. Now, in the second layer of this scrutiny process, in sealed panel system also, we are keep changing. We so that it should be the new members should come forward. Their ideas should come, and I am very thankful to the chairman. He has taken this initiative, and this is the brief. And today, this webinar, the very purpose of this webinar is to bring into the notice of the industry colleagues, auditors, and the technical reviewers, the observation which the technical reviewers, the observation which sealed panel, the observation which jury panel have while reviewing these annual awards nominations. So we have the presence of Honorable Speaker of the Day, the very learned professional CA Sandeep Shaji. Is a very he don't require any if something comes on review of financial accounts. I think none other than him. He has contributed last year. Without his support, it was quite impossible for us to meet the timelines. So we have the presence of our honorable chairman, C. Anuj Goyalji. C. Anuj Goyalji, I think most of the chartered accountant knows him. He is having 5th term in the council. He was Central India Regional Council chairman. He is a member of all the three institutes. He is LLV, he is MCOM, he has DSA, DIRM, and top of all these things, he is a very dynamic personality. he has blessed. He is contributing like anything. He is giving his time to the profession for past 25 years or more. So with these words, I would request Honorable Chairman to the committee, C. Anuj Goenji, for his opening remarks and welcome. Over to Chairman.
Thank you, Dr. Amit Agarwal ji, our young and dynamic Secretary of Research Committee and Committee on Capital Market and Investor Protection. I welcome our Honorable Resource Person, none other than Sandeep Saha sir, who has contributed like anything in the Research Committee last year also. And of course, we are having the presence of CA Amit Agarwal ji from the Research Committee, and Mr. Sekhar from Committee on Capital Market and Investors Protection. And we are having CA Prashant Jha ji from Darbhanga as one of the panelists. I think this live webinar, in which we are having the presence of chartered accountants from each and every part of the country, or rather the chartered accountants are with us outside country also. I welcome all of you to this very, very important webinar on discussions on commonly found observations in financial statements of past nomination of ICAI Awards for Excellence in Financial Reporting. And friends, there is a saying, time is not measured by passing of years, but by what one does, what one feels, and what one achieves. With the onset of another financial year ahead, we stand at the junction with the chance to build a fresh start. And after this corona, after this pandemic, I think the approach of the chartered accountants, who are the best accounting professionals across the globes, has changed like anything. We have converted this great threat into a great opportunity, and we chartered accountants are trying our level best to see that how we can come up to the expectations of the society, how we can come up to the expectations of the regulators like ICAI and Ministry of Corporate Affairs, Security and Exchange Board of India, and the government at large. Friends, you must be aware the Research Committee of the Institute of Chartered Accountants is one of the oldest technical committee set up in 1955 with a view to undertake research activities to improve the quality of services rendered by the profession. And last year, in spite of pandemic, in spite of corona, we have taken a lot number of initiatives. One such initiative was ICAI Doctoral Scheme 2020. And now this year we are having this ICAI Doctoral Scholarship Scheme 2021. And it is open for all the young members up to the age of 40 who are pursuing PhD. The scheme aims to provide scholarship to the eligible candidates having outstanding academic record in 10th and 12th standard. And I think the chartered accountants who are having an inclination on a whole-time basis, they want to go for the research work, who want to go for the PhD. We are encouraging them, and a scholarship up to rupees 50,000 per month we will be paying to the eligible research scholars for 3 years. We will be very high power shortlisting committee which will be scrutinizing the applications, and before that, of course, the research committee will be giving its views about the application, and finally the research committee will be finally accepting the recommendations of the shortlisting committee of every region. So I'm quite hopeful that the young chartered accountants who want to do really something concrete in the field of the research will certainly come forward and will try certainly to do something very, very concrete for the cause of the profession, for the cause of the nation. And as Institute of Chartered Accountants of India is a partner in nation building, I think through young chartered accountants who want to do the research on the topics which are very, very good for the profession, which are very, very good for the nation, I think we will certainly prove that ICAI is the real partner in nation building. In addition to that, last year itself, we come forward with a ICAI Research Project Scheme 2020. And this year, again, we are having this ICAI Research Project Scheme 2021. And in spite of this pandemic, in spite of this corona, and number of applications were shortlisted, and practically every shortlisted research project was completed in the given time, that is the 6 months, and the topics which were there, which were very, very good for the nation. And we are trying our level best to see that how we can prove ourselves a very, very good stakeholder in the mission of the Prime Minister Modi towards the 5 trillion economy and for the Atmanirbhar Bharat. And this research project scheme will be very, very useful of this mission of the government of India. And one very, very important initiative which we have taken, ICAI International Research Award 2021. This for the first time, any member of the International Federation of Accountants have come forward with this ICAI International Research Award. And in spite of pandemic, in spite of corona, we have initiated this initiative, and we got very, very good response. We were having around 100 nominations from each and every part of the world. The president of International Federation of Accountants, IFAC, was one of the jury member, and immediate past president of IFAC was the chairman of the jury. And we got the nominations from various countries, and we had the ICAI International Research Award program along with ICAI Awards for Excellence in Financial Reporting in Delhi, and was really a very, very successful event. And this year we intend to have this International Research Award event at Dubai, because it is an international event, and we are having very, very good presence in the Gulf countries. So the last date of submitting published research papers is 31st May 2021. We will be having all these details on the ICAI website, and individually also Dr. Amit Agarwal ji will ensure that it reaches to each and every member, each and every stakeholder, because not only chartered accountants, I think every researcher can take part in this ICAI International Research Award 2021. And as far as the ICAI Awards for Excellence in Financial Reporting, for which we are having this webinar, since 1958, we are having this ICAI Awards for Excellence in Financial Reporting. Last year, in spite of pandemic, in spite of corona, we got the highest number of applications in the last 7 years. And this year, we have added one category in the municipal body, and we have deleted one category of integrated reporting. And I am quite confident that when we will be discussing the things in advance, so whatever commonly found errors are there in the financial statements, Sandeep Shah sir, who is having a great experience, will certainly guide us that how we can try to improve our financial statements so that we can compete in the best possible manner for the ICAI Awards for Excellence in Financial Reporting. And the last date for submission of the applications is 30 September 2021, Amit ji?
Yes, sir.
Yeah. And with a view to improve and encourage excellence in preparation and presentation of financial statements, this webinar is being conducted to acquaint the corporates about the commonly found observations in past nominations to lead them towards better presentation, disclosure, and towards appropriate decision making. I take this pleasure in welcoming our honorable dynamic speaker, CA Sandeep Shah ji, to throw some light on the commonly found observations in financial statements of past nomination of ICAI Awards for Excellence in Financial Reporting. And I compliment the team of the research committee led by Dr. Amit Agarwal ji. CA Amit Agarwal ji is doing great work in this endeavor of the research committee, and we are having our young chartered accountant CA Prashant Jha ji from Bihar, who is going to contribute for the research committee in a very, very good manner. So I once again welcome CA Sandeep Shah ji, and over to Sandeep Shah ji. Thank you very much.
Thank you, Chairman sir. Thank you, Dr. Amit Agarwal ji. And Thank you, Secretary, from the Secretariat, Amit, again. Good afternoon to all my professional colleagues and listeners on an extremely important initiative which both the Chairman Sir, in conjunction with Dr. Amit Agrawalji, has taken. And I think timing-wise, this could not have come earlier, because as the year is about to get closed and the innings for the, let's say for March 21 for sure is about to be played. And the endeavor in this session for next 1.5 hours is to try and share both the experiences around the generic challenges over the years in terms of specifically India's financial statements, and also try and see as to how the efforts can be put in to improvise the financial reporting. I would be happy to take questions at the end of the session as well. And with this, I would like to, uh, Amiji, is the screen visible?
Yes, sir. Yes, sir.
Okay. So the topic specifically allotted is the arising from the ICAI Awards for Excellence in Financial Reporting, and what are some of the commonly found observations in past nominations. And here we are talking about at least for last 3 years, since India obviously has gained traction in the country. And I once again compliment the research committee for this initiative. So the presentation essentially has three sections: the background, the observations in India's compliant financials, and some conclusions arising from this. As far as the so as they say, excellence is not by default, but by design, perseverance, and efforts. And the very fact of the awards is excellence. We are, and the initiative and the efforts of the research committee is not to reward mere compliance, but is to reward and acknowledge the excellence in financial reporting. And financial reporting is not only a set of financial statements, but undergoes all the aspects, from the director's reports to MDA sections to additional notes to the corporate governance report. Everything encompasses what we call is excellence in financial reporting. And how does the entire report talk to each other is what the endeavor of the Shield panel members, supported by the technical reviewers, and mainly what the juries are looking for. They are looking for a comprehensive inputs to say that what makes one report better than the other. We are not say we are, and that is has been in my experience every time a very large jury members who are reviewing the presentations made to them for selection, that is what they are looking for, that fine aspect of a differentiation. So what does a financial statement, if I have to say from a reader's delight, right? We talk about customer's delight. Here is about a reader's delight. That when one reader looks at a set of a financial statement, what will give him or her the delight? And for you to get, Haji, just 1 second, please. Just 1 second. Is that now on a full screen? Yeah, okay. Thank you. So I was on a point on the Reader's Delight, and we heard the chairman sir say that the last date for nomination for March 21 financials will be 30th September 2021. And therefore, what will it take? It will take plan and preparing. That's a starting point. Execute during the course of the preparation, and then finally report. And in our experience, if all the 3 steps are taken in regard to the financial statements, it has to produce nothing else but an excellent report. So what are some of the significant factors for selection of the awardees? Compliance with the applicable financial reporting framework, the concerned regulators, be that SEBI, IRDA, SEBI, and whatever are the other regulators, the guidance note and other authoritative literature issued by the institute, the nature and quality of the presentation of the financial information. Presentation of the non-financial information is also an important aspect. The qualitative disclosure, both in terms of the accounting standards, the applicable Schedule 3 of the Companies Act, whatever the Division 2 or 3, guidance by the concerned regulators, guidance note issued by the ICAI, and others being the content of the quarterly results, because this is also an equally important aspect. The ratios and analysis, quality of statement of value added, and integrated reporting. All of this are a comprehensive set of review mechanism which goes through, and there are weightages given to each of the section to understand that whether finally how does one report differ with respect to the rest of the applicants in the same category. So I will begin with some of the observations in the Ind AS compliant financial statements. And currently what I have chosen is to go according to the revenue and then the assets and liabilities. That's the method in which we have gone. And then we will touch upon some of the residual items, and time permitting, I would like to share something specifically around the OCI or the cash flow statements additionally, but that is on the time permitting. Starting is about the revenue adjustments which are not disclosed. Now, this is a case, as we know, that we are dealing with Ind AS 115, and this was a situation where there were extended warranty and other adjustments which are not disclosed in the reconciliation with the contract revenue. As we know that the Ind AS 115 has a requirement under para 126AA to provide a reconciliation between the revenue recognized and showing separately each of the adjustments made to the contract price. For example, discounts, rebate, refunds, credit. Now, you have a composite contract value in which there are extended warranties, and a portion of that warranty gets accounted as a part of your revenue. And this paragraph requires you to give that reconciliation as to how much have you reconciled out of the opening plus fresh, and what have you recognized, and what is the carry forward item. Now, these are the aspects which are looked at both from the accounting policy disclosure under the revenue note, and then finally under the disclosure. So as they say that the care has to be taken around the reconciliation requirement and a disclosure requirement in regard to this particular provision. And we have seen many companies not attempting to provide this breakup, whereas from their financial statement, it is evident that there is a breakup from a contract price to a revenue. Going forward about a business combination and transaction cost. As we know that paragraph 53 of Ind AS 103 requires the transaction cost as expense in the period in which the costs are incurred and the services are received. Now, this is a requirement of, in brief, the gist of the requirement of the para 53. Now, when we look at the requirement vis-a-vis what is the disclosure which has made in the financial statements, and we find that many a times the wordings are very loosely reported, which can mean that you can be compliant or you can be non-compliant. So while you may have in spirit complied, but what is seen as a part of your disclosure is what is going to be interpreted as the method in which the recognition and measurement has have taken place. And so this was a case where the adopted policy on business combination mentioned that the acquisition related costs are generally recognized in the statement of profit or loss as incurred. Now, the word generally is not to be found in the standard, and this word generally can mean that it's a pick and choose. I may decide to put some cost as a part of my transaction cost and put it to the profit loss account, or some I may treat it as a part of my acquisition cost. Now, if the para 53 has to be complied in full sincerity, then this word generally cannot be there. And so by recommendation, while we are reviewing all policies, all statements, we are also trying to look for that whether is the presence of any word or absence of any word can lead to an interpretation which is not in consonance with the requirement of the standard. And this is for all my listeners here, what may seem to be a very innocuous presence or absence is, but becomes a kind of a differentiating factor that whether will this entity will get selected for the purposes of reporting or will not get selected. Going forward, we have the prepayment and rebates which are to be considered in the effective interest rate. As we know, the Ind AS 109 has the specific requirement, and here was the case where the policy read that rebate on account of timely payment of borrowers is recognized on receipt of entire interest amount in due time, and prepayment premium is shown as fee and commission income. Now, the question is about what is the requirement of the standard, whether can you postpone the recognition to a later date, or is this policy in compliance with the requirement of the standard or not. And the standard requires that when calculating the effective interest rate, an entity shall estimate the expected cash flows by considering all contractual terms of the financial instrument, for example, prepayment, extension, call, and similar options and others. And therefore, only using this entire revenue, which may be some subject matter of estimation only on cash method, is not a requirement compliant with the standard. And so therefore, again, the urge is to see what is the requirement and then what is the challenge around measurement. And then comes a question that whatever is the challenge around recognition and measurement, how does that get explained in the note will complete the standard requirement and the method in which recognition and measurement has to have taken place. But in absence of any other note which complies with the requirement of the standard, again, this will be treated as non-compliant. going forward, this is, as we all know, that the estimates and judgments are part and parcel of the reporting exercise. And the question is that whether under the Ind AS framework, whether an estimate and judgment, whether they are equal or are they a separate segment to be dealt with separately, with both of them having separate set of inputs. Now, significant estimates and judgments are presented together, but what is significant judgment? So you have para 122, which says that requires the disclosure of judgments, and which is very different from estimate that management made having most significant effect on the financials. And we all know that we have passed through the COVID era last year. What better experience can all the preparers and the reviewers and the auditors who have gone through this whole financial reporting exercise under the framework of the estimate and judgment, both in terms of how will the COVID pan out, what will happen to my revenue, what will happen to my expense, what will happen to the contractual commitments, whether the, you know, all every possible scenario under the COVID situation has been experienced, and we are still experiencing, and we still have an aftermath of the COVID flowing into March 21. So there will obviously be a carryover of the estimate and judgments which were made last year and what will be made again in March 21. So specifically, as we know that the estimates and estimation uncertainty, that's a separate dealt by paragraph 125. And what does 125, what does it require? Disclose information about the assumptions made about the future, major sources of estimation uncertainty having risk of material adjustment, and details of such assets and liabilities are required. Now, as we know that both of them operate while under the same framework, but both of them have got a very different role to play. Now, what we find is that in the financial reporting, we find there is a boilerplate disclosures, whereas the investors expect clear and concise details about its application. So if there was something around the recovery of loans, recovery of debtors, or of the you know, the amount of plant which would run, the capacity utilization, the arising out of the ECL model, about the fair value, there were so many judgments, the economic scenarios, the global scenarios, if you were in domestic market, the international market, connected market, all of them have a different role. You cannot club both the estimates and judgments and the estimation under one bucket and make a one single line. And we urge to the listeners that please pay attention to para 122 and 125 and as to how the disclosures should be made for both these items is something which we would love to see in the financial statements as they get prepared for March 21 and forward. The next item I would like to see and share is around the share-based payments, which is Ind AS 102. And as we know that you can have modification of the share-based payment arrangement, and in many cases we have seen last year that because of COVID, the market prices were depressed, the exercise price versus the market price were different. The targets which were supposed to be achieved, they possibly went out of the window, and therefore in many cases we saw that the share-based payments were modified. And the question which we were looking for out of the cases where the share-based payments were modified, what is the accounting policy to include the aspect of modification, and whether the accounting was done in accordance with the guidance in para 27, 29, and B42 to B44 of Ind AS 102. And we found, sorry, that there was a lot of, I would say, deficiency in this area as well. And so therefore, for all those companies or reporting enterprises which have got share-based payments and which are going to modify some of the terms, we would urge that please have a look at the accounting policy and its treatment and whether this is in accordance with the requirement of the standard or not. Going forward, as we know that the many companies which are in the NBFC space, which are holding assets by way of a collateral for the loans granted. And the question is that whether, as the collateral will not feature in your financial statement but will feature in your notes unless the collaterals are settled against the loan and becomes a part of your own asset, both either for operating or for held for sale. But what is the requirement of the standard 107? And as we know that you have 107 which deals with the disclosure of financial instruments, you have 109 which deals with the financial instruments, and then you have 113 which deals with the fair value measurement. And specifically Ind AS 107, which has to do with the financial instrument disclosure, it's one of the, in our opinion, 107 is an extremely important standard, because anything and everything around fair value measurement and its disclosure, you will find that 107 is trying to cover. And unless a lot of efforts is given to this standard, you will find that while recognition and measurement may have happened correctly, but the disclosures will lag behind. And the moment the disclosures lag behind, the financial statements also lag behind. So what is the challenge around the assets which are held by way of a collateral? And I would specifically here like to look at para 38 of Ind AS 107. It requires disclosure for every financial and non-financial asset acquired by taking possession of collateral assets. And what are you supposed to disclose? Nature and carrying amount of the assets, policy for disposing of assets not readily convertible into cash or for using them in operation. And what we have found is that either in some cases, the collaterals were given only for label 1, it was not given for the others, or there was no policy at all as to how do you deal with the aspect of disposal of collaterals. While as we know that the Reserve Bank of India, particularly as far as the jewelry or the gold loans are concerned, there are specific requirements in terms of how those collaterals are dealt with, how many auctions took place, what was the shortage, whether whether the company participated, because obviously they could not have participated, but a positive statement has to be made. So there were, apart from 107, there were obviously requirement of the regulators as well around the collateral. And we found that the narrative description of collateral and its impact on the ECL, particularly the para B8G of Ind AS 107, is something which we again found lacking in many financial statements. And here I'm not only restricting, because you can hold, you don't necessarily have to be an NBFC for the purposes of this, but there may be various other industries who will be holding the assets by way of a collateral, and therefore it is all pervasive. That takes us to the next item, again on 107, on the fair value of financial assets and liabilities. And then, as we know, that fair value is the heart of the financial statements. And in specific, I would like to bring to notice the para 25 of Ind AS 107. What does it require? it requires for each class of financial assets and financial liabilities to disclose fair value, and not selective for each class. And so therefore we have also found that either it is left blank, or in some cases nothing is mentioned. And it also requires that it is disclosed in a way that it permits the comparison with the carrying value of the assets. The whole objective of the fair value standard on 107, and particularly on the disclosure, is to be able to compare that whether is my carrying value equal to fair value, or is my fair value substantially higher than my carrying value. And you will see this, cutting across various standards, where they, because finally the financial statements are meant for use by the readers. They are not supposed to be hiding information from the readers, where they can intelligently, either as an investor, either as a lender, either as a stakeholder, or either as an analyst, or as a research academics, whatever, there are multiple users, and therefore all of them are trying to look through this standard for the purposes of looking at the degree of comparison between what are you valuing and carry forwarding in your financial statement, as opposed to what is the fair value. If the between the two, if you have to carry a value at lower of the cost or fair value. Now, and therefore, what was our observation? Financial assets and financial liabilities were at amortized cost. Fair value compared to the carrying amounts were not disclosed. Now the standard has no exemption around whether are you under amortized or FETPL. FETPL in any event would mean that everything is at a fair value, but more so, this gains importance the moment you have something at amortized cost, because you will have a fair value in this category of financial assets or a liability for sure, right? Going forward, again, transfer of financial assets that are not de-recognized in their entirety. And again, I'm looking at para 42D of Ind AS 107, which requires the cases where there is no full derecognition. What are the items or requirement for disclosure, and whether, and what was the deficiency we found? So we found that either there was complete non-compliance with para 42D, or selectively only some portion of the disclosures were made, rest were left to our judgment that whether would they apply or would they not apply. And unfortunately, when there is a selective disclosure, the needle is always on non-compliance rather than on the compliance. And so therefore, again, our urge is that when we want to move from a mere saying that we feel that this is compliant, but if you want to move to excellence, it is important that that extra line, extra word is featured, so it is not left to speculation. And so what were some of the non-disclosure or inadequate disclosure relating to? So they were relating to the restrictions of use, the risk and reward, the relationship between the transfer assets and associated liabilities. So what was the associated liability which the company retained, and how will it have impacted their financial statements in that year and going forward? The fair value and carrying value of the asset transfer and associated liability, again, we found that this part was significantly missing, and a reconciliation. So each of these are important tool for a reader to understand that if there is a partial derecognition, then how is the compliance with Ind AS 107 happening? Moving forward, the inventory policy incorrectly drafted. Now, many a times, as they say that fair value has an overpowering mindset, and therefore in many cases, innocuously, what is supposed to be a net realizable value gets substituted with fair value. And so here was a situation where we have found that in an inventory policy for inventory, it was stated that are stated at lower of cost and fair value, except scrap or waste, which are valued at net realizable value. And as we know that Ind AS 2, the fair value and NRV are not equal. Both of them operate under a different situation. The net NRV is entity specific value and may not be similar to the fair value of the inventory, as fair value is not entity specific. It is what would a willing buyer and a willing seller in a open market pay for a price is what goes under the NRV. It is not necessary that in that fair value the cost to sale will get reduced, and so therefore the requirement of Ind AS 2 is NRV, which is to take your selling price minus cost to completion minus cost to sale. So all of this will finally define what is my NRV, and so therefore again we have found that in some of the cases this words gets replaced, leading to non-compliance with the standard. And this is something which is going to be extremely important for every team member in an audit team also to look at the words very, very categorically, because as I had said at my outset, plan, prepare, execute, all of this are not an exercise only after the entire audit is done. This is something which has to be also reviewed while the audit has commenced, so that any changes which are necessary during the course of the audit, during the course of the final preparations are factored. This is my, a kind of a midterm, again, reiteration, which I would like to bring to the attention of the audience. Now, this was another example, in the category, and specifically more so in the category of the NBFCs. As we know that there is a business model and what turns out to be in reality, and the business model obviously plays an important role, that whether your financial asset will go under an amortized cost category or will go under the FETPL category. And so what does the business model? You can most of the business models will be to hold the financial assets to collect the contractual cash flows, right? So both the interest and principal SETP test is what we are saying is the business model test. Now, does the standard prohibit that only because the business model standard is to say that you are holding it to collect the contractual cash flows, that means I must, irrespective of whether how quick the deterioration or unexpected deterioration of the asset is happening, I must still hold it till maturity because that is what my business model is? Certainly not. The standard does not expect you to say that you incur losses only because you had said or the company had reported this is to be asset is held to collect to contractual cash flows. But what does the standard therefore also require? It requires a statement as to how the underlying sales versus the business model is tying together. Now, these were cases where over the last 2 years, it was observed that there are frequent sales or securitization or which may also be derecognition of such assets. Now, no explanations were provided as to how some of the criteria specified in 109, and specifically I'm referring to para B 4.13a or 4.13b have been met, resulting in disposal of such assets. And as we know that the para 4.13a requires that there may be sales due to an increase in the assets credit risk. This can be one of the reasons why there were disposals, because you are in a lending situation. For your ECL model, you would have a certain parameters as to how the asset or a pool of asset will behave, and there might be some credit risks which you have already envisaged at the inception, and that is how your ECL model has been formulated. And now you may find that in certain cases, all of a sudden, there is an increase in credit risk beyond what was anticipated. What does the standard require? The standard says that only because this is held to sale does not held to collect does not mean that you will not dispose of. But have you disposed of? Then comes a question that what additional information are you giving to the users to provide the underlying conditions? Because if I have a deterioration in credit risk, which was in 2019, and I dispose of the asset in 2021 prior to collecting the contractual cash flows, then obviously these are under two separate periods, and therefore one cannot use that understanding for the purposes of disposal. The prudence would demand that if there is a credit risk or if there is a significant change in interest regime, the prudence would demand that the company will take action and dispose of, and then justify the underlying conditions vis-a-vis information. And why I'm just spending little more time on this particular slide, because this is impacting an entire industry which is under the NBFC regime. And we would both, in terms of the 4.13A and B, and obviously there is further in the basis of conclusion para B 4 1.43 to BC 147. There is significant amount of information which has been given, and note coupled with the compliance with the final treatment will give the reader a perspective that how an amortized category is the right choice made by the company, and any deviation during the year in disposal was still in compliance with the requirement of 109. I mean, this is something which I thought it has been an area of serious deliberation at the committee level, and we find that the financial statements were not sufficiently forthcoming for the reader to understand the compliance, particularly when the amortized cost category was selected. And also this was juxtaposed with what is the means of how the fundraising and the capital requirement, what is mentioned in the MDA section, that was also looked at. Further, again on the Ind AS 107, particularly on the credit risk, and here again I would like to bring notice to paragraph 35F and 35G. These are the two specific requirements and disclosures in the financial statements as to what is the credit risk management practice and what relates to recognition and measurement of ECL. And what does it require? Entity definition of default with narrative for opting this definition. This is one part of the disclosure. How the financial instruments were grouped if expected credit losses were measured on a collective basis. Obviously, you have to bring the apples together, but now if you try and bucket uncomparables under one, you still have to be giving out that as to how do they have a common characteristics for it to be grouped together for the ECL purposes, particularly when you are measuring on a collective basis. How an entity determined that the financial assets are credit impaired financial assets. Now there has to be these are deep-rooted information, because what the management uses for the purposes of defining whether it is moving from stage 1, stage 2, stage 3, there has to be, what is the basis of determination? Again, a qualitative disclosure as required by para 35F is what is being looked around. and what is the entity's write-off policy, including the indicators that there is no reasonable expectation of recovery and information about the policy for financial assets that are written off but are still subject to enforcement activity. And as we know that that the companies will choose to fully provide for the financial asset carrying value and still will be pursuing the recovery. It may fully securitize and sell away the entire asset to the ARCs or any of similar reconstruction companies. But the question is that earlier, under the old regime, when we used to write off the bad debts from the trade receivable, there was no requirement to say under which circumstances will you time the bad debt against the provision for doubtful debts which you have made. But 107 para 35A has a specific requirement that what is your policy for write-off. Going on to the paragraph 35G, you have to explain the inputs, the assumptions and estimation techniques used to apply the requirements of para 5.5 of 109. And what are those explanation? It is relating to the basis of inputs and assumptions and the estimation techniques used to measure the 12-month and the lifetime expected credit losses. As we know that for the trade receivable, a simplified approach is available, and determine whether the credit risk of financial instruments have increased significantly since initial recognition. As we know that even the Schedule 3 Division 2 and 3 requires a specific breakup of your TRs in terms of since inception, whether there has been a significant increase or not, and whether are you tracking, are you not tracking, now, and then last is determine whether the financial asset is a credit impaired financial asset or not. Now, again, we find that the amount of attention which is paid to the disclosure of para 35G requires little more attention of the preparers and of the auditors is what we can say, particularly because credit risk is an extremely integral part, whether, and credit risk is all pervasive. If you're it is not necessarily an NBFC, right? It can be even a manufacturing company which has got extensive exposure on the trade receivable. There can be companies which have got long duration, extended credit period. So credit risk is all pervasive, and we urge that attention be paid to the disclosure requirement of both para 35F and 35G. Going forward, the classification of incentives receivable under export incentive scheme, while compared to March 19, I would believe that the number of errors which we have seen have reduced, but nonetheless they are not less. As we know that whether under MEIS or SEIS incentive schemes which are available, and the question is that whether this incentives from government represents financial assets or do they represent a non-financial asset. So while there is and we have found that the both in terms of the requirement of the standard duly supported by the ITFG group, the requirement will be that such receivables will have to be classified as a financial asset. There was an argument that there is no privity of contract between the entity and the government, but we have to also appreciate that the right of the entity to receive a benefit under the scheme is under a policy of the government, and therefore it will apply to every entity which complies with the stated policy, and therefore to that extent there will be a contractual arrangement. May not be the written contract as we understand, but contract through the mechanism of the scheme, and which if it is complied, the government is duty bound to give you the benefit as prescribed under the scheme. And therefore it is understood that the entity on complying the stipulated conditions attached to the scheme, the entity will be granted benefits of the scheme, and therefore we expect that the companies, even for March 21, while the current scheme, the government has not fully extended, but there will be still certain amounts of receivables which the corporate entities may not have got, and therefore if they are classified as non-financial assets, it is time to relook at the compliance. And for little more clarification, I also draw attention to the ITFG Bulletin 15, issue number 3, which deals with this topic as well. The other aspect where we've again found, I would say, deficiencies compliance with the requirement of the standard, or if you were choosing an option which was outside the framework, then there are also additional requirements to support the treatment. And in specific, I'm looking at the impairment test consideration. Now, we have seen that the companies have in many cases taken cash flow projections greater than 5 years. So in some cases, they have said that they've taken 10 years. Now, as we know that while there is no bright line test to say that, oh, it's only 5 years, but what does para 134D3 of Ind AS 36 requires that if you choose to take a cash flow projections greater than 5 years, then you have to justify as to how those projections beyond 5 years are relevant and important and are capable of being projected for the purposes of the impairment test consideration. The whole requirement is that as we go more into future, the greater the uncertainty, the greater, and COVID has been a classic reality check for every human being, who was there during the pandemic and continues to survive. We have seen that all the possible projections have gone for a complete swing. But nonetheless, COVID or no COVID, the question is that if we take projections greater than 5 years, one will have to justify that as to why those are more reliable, predictable, and how they are relevant for the purposes of the impairment test. That is point number one. And so therefore, a greater amount, and in this particular case, we found in more than one cases, as I may say, we found that there was no disclosure justifying a period greater than 5. And the second, again, aspect which we have found are that a post-tax discount rate was disclosed. And as we know that the paragraph 55, the requirement of the standard is to use pre-tax rate. There have been deliberations internationally, even at the ISB level, that if I use a post-tax cash flow, then whether can I use a post-tax discount rate. But unfortunately, there has been no consensus. Both the answers may not be identical, and therefore the requirement of the standard until it is amended, where they may give a choice to consider a post-tax rate with a post-tax cash flow. Until that happens, the requirement is to use the pre-tax. And so therefore, on both these counts, we have found that in cases where while the cash flows were 5 years, but discount was post-tax, in some cases it was in a different combination. And again, would urge a compliance with this requirement. Going forward, there was a situation of fair value of financial guarantee obligation. As we know that the financial guarantees are dealt either by 109 or by 104, the insurance contract, if since inception, financial guarantee contracts were dealt by 104, because that's a policy choice which was available in transition. And the question was that how does the fair value obligation and what are the things which we have seen that this is one of the significant area of errors which have crept in many financial statements, in different combinations. I will not say that there is 100% non-compliance, but different degree of non-compliances were observed in various instruments. And as we know that 109 defines financial guarantee contract as a contract that requires the issuer to make specified payments to reimburse the holder for a loss it incurs because a specified debtor fails to make payment when due in accordance with the original or modified terms of a debt instrument. And here it is not necessary that the entity has to be outside the group. It can be your subsidiary, it can be your joint venture, it can be your associates, it can be rank third party, but 109 does not distinguish between the, in a standalone financial statements, even a subsidiary is the and a specified debtor. And 109, the recognition principle is that the initial recognition is at fair value, and then the subsequent measurement at higher of ECL provision under 109, and amount originally recognized less amount recognized as income under 115. This is the broad framework as we know. And what are the some of the non-compliances? We have seen that in some cases there was complete absence of disclosure, while we could see that under the contingent liability, the guarantee given in favor of the component was mentioned. And as we know, Ind AS 37 specifically carves out the financial guarantee contract from the Ind AS 37, and therefore it cannot fall under the purview of the contingent liability at all. It has to necessarily fall under the purview of 109 or 104 as the case may be. And in many cases we found that the guarantee contract was unrecognized, and so therefore financial guarantee contracts is something which we have, again, we urge a greater amount of attention to be paid. Going forward on Ind AS 12 in relation to the income tax balances, so what are some of the observations which we have been able to see from the financial statements? And here was a situation of netting of the current tax and deferred tax balances, and in different cases on standalone, in financials, with in some cases with the subsidiaries being under different jurisdiction, as we could see from the nature of entities which were consolidated. And we find that so before we come to the what was disclosed, as we know that para 71 and 74 provides for netting off only when you have a legally enforceable right to net off and intention either to settle net or settle liability after realizing the asset. Now, when you set off the advance tax and provision for tax as well as a deferred tax liability and asset at the group level, you obviously would have, and no explanation. How does such company has a right of such set off, as we also know that refund of 1 year currently, even under the Indian income tax, you cannot set off that refund against the liability of the subsequent year. And so therefore, unless the right of set off has been ordered by the tax authorities, that refund cannot be set off against the liability of subsequent year. And we find that not sufficient attention is given to the netting off. Similarly, as we know that if there is a deferred tax asset on the unutilized tax losses, obviously from the Indian GAAP to Ind AS 12, now there is nothing called virtual certainty. It's everything is on a convincing probabilities. But only because from virtual certainty to convincing possibilities comes with a disclosure requirement. And I'm referring to para 35 of Ind AS 12, which provides that the existence of the UTL indicates that unutilized tax losses, which indicates that the future taxable profits may not be available. Entity recognizes DTA in such cases only to the extent DTL or there is convincing other evidence that sufficient taxable profits will be available. And what is the disclosure of convincing evidence supporting recognition of deferred tax asset considering the existence of UTL are not made as per para 82 of Ind AS 12. So there are, only merely recognizing the DTA out of UTL is not going to be sufficient compliance with para 82 of Ind AS 12 is another set of non-compliances which we have seen. Going forward, this was a case where there are investment in group companies, subsidiaries, there are large undistributed profits, and therefore it results into a temporary difference. And now what does para 39 of Ind AS 12 require? It says it requires to create deferred tax liability on temporary differences except the company is able to control the timing of the reversal of the temporary difference and probable that the difference will not reverse in foreseeable future. Now, in paragraph 81F, require the disclosure of aggregate amount of temporary differences on which deferred tax liabilities are not recognized. And in case of investments, the investor cannot control and hence unless agreement that profits will not be distributed, the deferred tax liability shall be recognized. Now, here is where I was coming, that silence would mean non-compliance. It will not be presumed that because the entity has chosen not to provide for the DTL and therefore one will fall back on para 39 and say that may be a part of your file note as an auditor or as a reviewer to say that why DTL did not get recognized because I'm able to control the timing. But if that does not translate into disclosure, your non-compliance with para 82, 81F will certainly kick in, and it will be presumed that the DTL was required to be provided and that the company could not have controlled the timeline. And in case of associates, in absence to the contrary, it will again be presumed that the DTL should have been provided on the portion of the assets of the associate in the financial statements. So this is again so somebody may argue that this is an audit step requiring a compliance whether to provide or not to provide, but along with that decision making is also a requirement of disclosure. Going forward, and I always like my team, and at this point of time, I also would like to acknowledge my team of the Article Chartered and my partner Tripti, Nikunj and Bhavin, who have been extremely supportive in preparing this. And I must compliment that even at the article level, they are able to conceptualize the the graphics to say credit and risk. So what does the accounting policy on measurement of the ECL require? It basically 107 para 35F and earlier we saw paragraph 35G as well. So it also on the measurement of ECL, there is a specific requirement of disclosure which we found again in various degree of non-compliance. So there are multiple requirements. How entity determined the significant increase in credit risk. It certainly can't be on my whims and fancies. So observable, non-observable, whether is it based upon the overall credit profiling, whatever may be the available in set of information, the entity's definition of default along with its base, how entity determined that the financial assets are credit impaired, write-off policy, basis of inputs, assumptions, estimation, and use of forward-looking information in assumptions. So again, we require that one should look at this aspect very, very clearly and with microscope, is what I would like to say. Segment reporting, again, 108, sometimes as we call, that there is a hangover effect. The segment, the IGAP 17, which dealt with the concept of the business and geographical segment. And as we know that Ind AS 108 does not have such concepts, and therefore many a times innocuously the old policy statements on segment is something which was found even as late as in March 20 financials. So we would again in the plan prepare phase, it is important that the financial statements of March 20 are reviewed thoroughly for all possible areas which will require corrective action is what I would recommend as my plan and prepare, apart from additional new items which would have flown through in March 2021 financial statements, or the new set of activities or which may have got commenced where there is an application of a new standard. So that's as far as mismatch in the accounting policy flowing from the old Indian GAAP requirement. And also we find that many a times the preparers and the auditors read paragraph 34 very differently, and therefore they remain silent. The paragraph 34 of 108 provides for details of single external customer constituting more than 10% of the revenue. The standard does not expect the naming of that customer. What it says is that if you have a singular customer and which has got more than 10 exposure, then that information has to be dealt with where the disclosure is sufficient enough for the reader to understand that there is, what is that more than 10%, what is the composition of such customer, what is the impact that customer can have on the ECL model, the dependency. So there are multiple impact out of this disclosure, because everything is like for an NBFC, the RBI may have called about the credit concentration norms. Here, the reason we think that many corporates are shying away is because it is read to say that you need to name a customer. That's not what the requirement of the standard is, and so therefore the underlying major customers, the profiling of that customer, if it is more than 10% of the revenue, has to be disclosed by way of a note, and it is applicable to all entities and not necessarily only to the lending commodity or lending entities, as I may say so. There have been again on EPS also, which is a vital disclosure standard. Again, we find that the EPS, in some cases, the OCI amounts got included under the EPS computation, and as we know that it is OCI is not to be considered. In many cases, the weighted average shares were not considered, or there were no disclosure as to what was the anti-dilutive. Again, silence does not mean that the readers will presume why it is not there in the computation. And also we find that the disclosure like reconciliation of the amounts and shares which are considered for basic and diluted EPS were again not provided. And these are the cases where there were changes in the statement. There were cases where there were buybacks. So again we find that the attention to this aspect was not fully played for. We also, in my earlier slides, we also spoke about the quarterly results and the financial statements. And as we know that we have reported more than now 4 quarters of the under the COVID situation, March 20 included. And the question which was coming up, apart from the SEBI regulation 33, as well as RBI, which had issued the advisory on disclosure of material impact of COVID-19 in the results. Again, there cannot be a selective disclosure. Materiality needs to be considered. And you also have paragraph 8, Ind AS 8, paragraph 32 read with Ind AS 34, which is your para 15 and para 36. And here, even in cases of NBFC, where estimates were made for a management overlay without changing the ECL model. Now, obviously, when a management overlay was included, there are management estimates as to how the management overlay will be continuing, how will they be used, what are the parameters for withdrawal. We found that except for loose sentences, we did not find that in letter and spirit, the requirement of Ind AS 8 and 34 were complied with. And these were all cases where from the numbers, we could understand that there were significant changes in estimates. And so therefore, we urge that while the COVID was there throughout this March 21 period, attention should be paid to the regulatory requirement and the requirement of Ind AS 8 read with Ind AS 34. And I would urge the readers to look at both para 35 and 36. This has been another, the preparers or the reviewers may put this under an innocuous category, that the figures of the previous years have been regrouped, reclassified wherever necessary to conform to the current year's presentation. While this may be a factual position, but there is a requirement when you regroup, reclassify the items of the previous year. And therefore, I urge once again the readers and the preparers to look at para 41 of Ind AS 1, which says that if an entity changes the presentation or classification of items in its financial statements, it shall reclassify comparative amounts unless impracticable, and it shall disclose the nature of reclassification, the amount of each item or class of item that is reclassified, and the reason for reclassification. So this is an extremely important tool, leaving a sentence as we saw, which is reproduced at the bottom. Without compliance with Ind AS 41 surely is a recipe for this financial report to not be considered at all, because both the reclassification from previous year figure, it has got multiple implications. There can be something recycling, and because if this disclosure is not happening, many a times it may be a kind of a situation whether from OCI, whether is anything also reclassified which is technically recycling, for which there are different paragraphs. We find that very, very few companies have actually used along with the reclassification, the items, what was there in the previous year and where it has been regrouped, and wherever they have not been able to find and choose an impracticable route, they have also given the underlying answers as to why it is impracticable. Only because to say it is impracticable, everything is impracticable. But they have gone to the qualitative insight to justify the final position which they have taken. We have disclosure in statement of cash flows here. I'm looking at paragraph 38, which talks about shall include the cash flows of its investment in the associates or joint venture and distribution payments and receipts between it and the associates and JV. This is one requirement of para 38. And para 17 requires that it shall have a separate disclosure of cash flows arising from financing activities as it is useful in predicting claims on future cash flows by providers of capital to the entity. And in both these areas, we found that the company did not disclose the investment in subsidiaries and JV were not reflected separately under the cash flow. In many cases, it was included along with the investment in financial assets or shares, both within the component and non-component, which again, the standard requires you to segregate that. And also we found that the disclosures given in respect of financing activities were inadequate or not given in respect of financing activities, were restricted to only debt only. And we find that even under 116 also will eventually fall under this para 17. And we found that many companies had probably partially complied with this requirement of disclosure. And which specifically also talks about the net debt reconciliation, which is the non-cash change. So your para 44A to 44E of Ind AS 7 has a specific additional disclosure requirement, which says the disclosure for changes in financing activities arising from cash flows and non-cash change. And 44B, to fulfill the requirement of the disclosure, it expects to present changes arising from financing cash flows, obtaining or losing control of subsidiaries or other businesses, effect of changes in foreign exchange rates, changes in fair values, and other changes. And 44D requires reconciliation between opening and closing balances in relation to financing activities. Sufficient information shall be provided to link numbers with the financials. So, when you have a cash and cash equivalents and you have your EAFC balance, which in your cash and cash equivalents, you are treating the unrecognized changes in the currency rates as a part of your cash and cash equivalents. And if there is no disclosure under this requirement of para 44A to 44E, surely there is a non-compliance. You also have the changes on account of lease. You have also on account of fair value changes of the liabilities. So, there are so many cases which are self-evident from the financial statements, and we find that attention to this part is, and to a very great extent, the analysis or the lenders are using this very, very effectively. And just as a part of the to say that you have this also as a part of the disclosure initiative from ISB in terms of para 44A to 44E as to how they expect the non-cash changes between the opening reporting period to the closing reporting period under different categorizations to be disclosed. Going forward, this is a case where we have investment in a joint venture, and as we know that paragraph 54E of Ind AS 1 has a specific requirement that investment in equity or investment in JV, all that which are equity accounted, it will be in a separate line item on the face of the balance sheet for investment in JV accounted using equity method. So while the structure under Schedule 3 Division 2 or 3 may have on the financial assets as a category, but as we know that the disclosure requirement of the accounting standard will overrule the Schedule 3, and an additional line item will have to be incorporated to comply with the requirement of para 54E of Ind AS 1. So this is one area which is coming in as far as in the console is concerned. Standalone, obviously, this will not arise. But more importantly, if some companies have complied with 54E, we all have also found that if there were investments in joint venture which were in the preference shares, those also were be picked up by way of an equity method. And as we know that the treatment of those will flow under 109 and therefore will not be an equity pickup. And if it is not an equity pickup, it will go under 109. So we have seen selective non-compliances, or we have seen non-compliances altogether. So this is a very important aspect, more so because this is an interplay between between what we see in the division 2 and what we see as a requirement of the standard. Going forward, investment property disclosure for all those companies which are disclosing investment properties, we are and this is essentially flowing from the requirement of the fair value, as we know that the paragraph 75 and 79 of Ind AS 40 specifically deals with the fair value disclosure of investment properties, because currently we have a carve out where we do not permit investment properties to be fair valued. It has to be carried at the historical cost. That's the carve out which our MCA has taken, our Ind AS standards has got a carve out, right? So what is a disclosure? It says criteria to distinguish investment property from owner occupied property. What is the fair value of the investment property? What is the level of fair value hierarchy? And when the fair value can't be measured reliably, what is a description of such property, an explanation for non-possibility, and if possible, range of most likely estimate, and the basis of valuation and its validity. Many times it only says that we have taken the Reckner rate without any further disclosure. Now, whether the Reckner rate is equal to fair value or not may not be. So again, one will have to be extremely careful as to what may be the fair value for stamp duty purposes may not necessarily be the fair value under the Ind AS framework definition standards of fair value. And this is one area where we have seen not too much attention is being played. And also, as we also know that when you are using a fair value determining unobservable inputs, and as we know that the investment properties are obviously not going to be actively traded in the market. They are not like REITs, they are physical properties, and therefore in addition to Ind AS 40, you also have Ind AS 113, the fair value, the measurements and the disclosure, where para 93B, D and para 97 will come into play in case of investment property. The level of fair value hierarchy within which the measurements are categorized in their entirety, which is level 1, 2, or 3, a description of the valuation technique and inputs used in the fair value measurement, and in case of change, disclose change and reason, qualitative information about the significant unobservable inputs used in measurement in case of level 3 inputs. So both these standards will kick in if you have a fair value, if you have an investment property. My team obviously expects the value of the housing to go up. We also find that the level 3 fair value, again under 113, inadequate disclosures about, as we know, level 1 is quoted, observable inputs other than quoted, and third is unobservable inputs. And again, we have found that the fair value of financial assets determined under level 3 by using unobservable inputs following additional disclosure as per 91 to 99 are not made or were incomplete in many aspects. The description of the valuation process, the valuation technique, inputs used in such valuation, sensitivity of changes in such inputs, relationship between the inputs, reconciliation of opening balances to the closing balances, including gain losses recognized. And as we know that increasing investments are happening in the startup space, there are a lot of unlisted investments which are being made. There are some, in many cases, there are challenges that whether a valuation obtained by one component, whether can it be fully used by the another component. There may be different bases, there may be different percentage of holding, there may be different sensitivity, there may be different interrelationship, and lot of attention is being paid to level 3 disclosure, because from a analyst or from a regulator, everybody feels that level 3 is the black hole. Everything what has to go wrong is in level 3. Not necessarily. If you may have done the best of the application of the Ind AS 113, but any failure of disclosure would technically only fortify the view of the readers that level 3 means you can park anything and everything under level 3, which is really not the case. A lot of efforts are being put by the preparers and the auditors in level 3 valuation, and we do urge that the preparers and the auditors will pay attention to the disclosure here. Going forward to the provisions. Chairman sir, I have maybe another 10 slides. I should be able to complete maybe in next 10 minutes. We are at 6:42. So I have maybe another 10 minutes before the concluding remarks and maybe some questions. I hope that would be all right, Chairman sir or Dr. Agrawalji. So disclosure in relation to provisions, which is your Ind AS 37 para 85, as we know that the nature, the expected timing of the outflows and uncertainty on amount or timing of provisions were not disclosed by the companies or were insufficient. There has to be significant qualitative aspect of the nature timing. There may be certainly it may be dependent on certain resolution of certain underlying matters, but it is imperative that what those underlying matters are also stated, so that the compliance with para 85, which requires a brief description of the nature and expected outflow and uncertainty about either the amount or timing of the outflows, including major assumptions. And this can be in respect of whatever may be the underlying litigations or the tax disputes or whatever may be the nature of disputes. And we find again insufficient information in regard to items which are disclosed under the category of Ind AS 37, the provisions and the contingent liabilities. Capital management disclosure, as we know, is again an important aspect. Again, paragraph 135 and 136 of Ind AS 1 deals with the capital management, and capital management, as we know, are both stipulated by the regulators and are also how the entity manages it. Only to say, and these were some of the observations which we had, that only regulatory capital was treated as a capital management as required by under Ind AS 1. It will be an additional disclosure, but certainly not in substitution of the requirement of Ind AS 1. You can, the entity can give additional capital as prescribed by the regulators. So what does it require? The objective, the policies, the process for the managing capital, the quantitative data on management of capital, the compliance with externally imposed capital requirement. That's, as we say, is an additional requirement and not the only requirement, and need for segregate disclosure of each capital instead of aggregate. So again, we find that the composition, the component, and how the capital management practices, and if there are any changes between the capital management underlying basis in the previous reporting period vis-a-vis in the current period, the entire reconciliation and the explanation is going to be necessary for purposes of complying with this standard. Related party disclosure, again, we have found that there is a as we know that the requirement of Ind AS 24, it defines KMP as those persons having authority and responsibility for planning, directing and controlling the activities of the entity directly or indirectly, including any directors, whether executive or otherwise of that entity. And we know that a lot of arguments and heated arguments are happening that whether our independent directors, do they have the authority, responsibility, whether they are KMPs, or do they fall in this category of a director which are other than executive and therefore required. We find that even if one does not want to classify the independent directors under the KMP category, they can certainly be classified as an independent directors outside KMP, but still the disclosure under the Ind AS 24 can be made, so that both the need of the independent directors not becoming KMP is satisfied, and at the same time the requirement of Ind AS 24 is also satisfied. We also find that the employee welfare trust are not disclosed as a related party. Now, there is obviously another set of argument and disclosure which may be required, that whether those employee welfare trust, which are other than the gratuity and provident fund, whether other than these two, whether they were required to be consolidated, not consolidated, those are separate topic, as we know that obviously gratuity trust and other long-term benefit trusts are specifically excluded from the consolidation. But under related party, they will fall specifically as a part of under para 9. Such trust will be controlled entities, and therefore we find that a lot of entities are missing out on disclosure of contribution to the gratuity trust or other long-term benefits under the related party disclosure. Again, the corporate social responsibility, when a trust is set up by the holding company and the contribution is made, whether again under related party, we are not delving into the qualitative aspect whether the CSR trust needs to be consolidated, not consolidated, because these are various interpretational issues, whether is there a right to variable returns and control or not, or so the objective is not to look at the whether it needs consolidation or not. That's not the point. But having said so, if there is a contribution to CSR which is controlled by the parent, it will fall under the paragraph 9(6) of Ind AS 24, and therefore those contribution will have to be reflected. Again, the disclosure of dividend declared after the reporting period, and as we know that para 137 of Ind AS 1 requires an entity to disclose in the notes to financial statement the dividend proposed or declared before approval of the financial statements, but not recognized as a distribution to owners, related dividend amount per share, and any cumulative preferences not recognized. So we also find that there is we find some disclosure in the director's report, but we do not find the disclosure under 137 under as required by para 137 of Ind AS 1. So we also, apart from that, there is also requirement of para 12 of Ind AS 1110, which is event after reporting period. So we urge that only director's report of dividend declared during the course of by the directors during the course of adoption of accounts is not going to be sufficient compliance. Again, when we come to the Ind AS 115, we have para 114, which requires to disaggregate the revenue into nature, amount, timing, economic factors affecting the cash flows, or the interplay between 115 and operating segments, the reconciliation between disaggregated revenue and revenue presented under segments. We found that these two were not talking to each other. And again, we would like that both of them are in harmony to each other. And obviously other disclosures of 115, which is recognized in respect of opening contract liabilities or contract assets, the unsatisfied performance obligations, and significant changes in contract assets and liabilities. Again, we found that 115 disclosure was not sufficient. Non-disclosure of items under the OCI, as we know that para 82A, and whereas again schedule 3 may allow you to give the OCI item net of tax, but there is also, we have to remember that there is also a requirement of para 82A of Ind AS 1 and 91 of Ind AS 1, which requires that the items which will be reclassified into profit loss account, which will not be reclassified into profit loss account, has to be obviously segregated. And if there is a item which is given net of tax, then you have to give the tax item separately by way of a note. And before tax effects with one amount of aggregate taxes in such cases, right? So this is the aspect of your schedule 3 versus Ind AS 1 and the disclosure. And in many cases, we find that the retirement benefits, while there are from the disclosure under the employee benefits is there in the notes, but we do not find the actual gain losses change happening in the OCI section. So again, interplay between what one is reflecting under other disclosure vis-a-vis what one is reflecting under the OCI computation needs little thorough, I would say, reconciliation and attention. Again, as far as the right to use and lease liability 116, which got implemented last year, we again find that between the para 53, your additions to ROU assets, depreciation charge for ROU assets, carrying amount of ROU assets at the reporting period, by class of underlying assets and total income from subleasing of ROU assets, we found that there was various degree of non-compliances, and para 116, para 50 also shall classify in the financial statement the cash payments of the principal portion of the lease liability, which is under the financing activity, the cash payment of the interest portion of the lease liability as per Ind AS 7, again in a financing activity, and the short-term lease payments, low-value lease payments, and variable lease payments not included in lease liability measurement, which is under the operating liability. And we find that this para 50 has been complied or non-complied to a very different degrees. In some cases, the lease and interest got merged together. In some cases, the short-term leases were not separately reported. If 50 was reported, then maybe the schedule 3 was not reported. So we have found different degrees of non-compliances around 116 and 21 being the second year. We urge little more attention to the 116 disclosure requirement. Quickly, on a wrap up, some of the miscellaneous observations. While SEBI does permit that you can circulate the abridged financial statements, but the link to the full financial statements in the website has to be given. And we find that when we clicked on the link, unfortunately, the full financial statements on a standalone were not available. CFS in any event has to be fully, there is no abridged version on CFS, but SFS, while SEBI has given that approval. But again, so if the link is not available, as we say, this is excellence. One will have to be careful as a reporting entity that it is available at the link at which is provided. Again, we find that the effective year were wrongly measured for Ind AS. So many a times it was a case of a copy-paste syndrome, as we many a times say. Mandatory disclosure in the corporate governance report relating to name of directors who possess the identified list of core skills, expertise, competencies as required in the context of its business and sectors was not disclosed. So again, we are also looking at this CG report and the compliance with SEBI guidelines. We sometimes have also observed that in a manufacturing industry, the secretarial report said that there are no sector-specific law applicable. Now, unfortunately, in a manufacturing reporting entity, this would be unlikely, and obviously there were other related matters in the MDA section which said that this sentence was not correct. Non-cash movements not disclosed by way of in cash flows I've covered. Operating cycle was not disclosed as a part of an accounting policy, because this is also important, that whether is 12 months taken by default, or do you make a positive statement, and how do you handle the operating cycle? So everybody knows that it's a correct policy choice and not by default. Again, the statement of compliance with Ind AS not presented separately, and it was clubbed under the basis of preparation section. Both of them are independent. Your wrong effective dates for Ind AS applied during the year. Accounting policy loosely drafted and transition under 101 also not correctly presented. In conclusion, integrated report and qualitative information. So expectation of stakeholders and business community is adequate quantitative and necessary qualitative disclosure. It's a communicative report. It's a error-free. The zero defect principle says do it right the first time, and Phil Crosby has rightfully said that if you hit the bullseye first time, then the rest of the efforts will all fall in place. And I may, while we have spoken quickly in terms of, what are the non-compliance observations, but I would like to highlight, what has caught even our readers' delight. An insightful MDA with a detailed analysis of financial information, operations, business drivers, sector trends, voluntary preparations of the integrated report, good use of the graphs, charts, ratios to explain the performance. If they were using dollar values, they have clearly articulated what was the dollar amount translation taken last year, what is it taken this year, so that people, the readers, are able to understand that whether 100 million becomes what was 100 million in Indian rupee terms last year and what is it in the current year. So, the companies have taken great pain in terms of translating the consistency value, the statement of economic value generated, distributed, the good discussion on innovation, sustainability development, in CSR, the specific and time-bound measurable actions, the reconciliation between standalone and a console, something which is very, very nice. How SFS has moved to CFS in terms of assets and balance sheets and revenue items, or profit loss account and balance sheet items, consistency of information, denomination. In many cases, even under 115, what transactions were in legal nature by way of a sale or a purchase, but if they were accounted differently in compliance with Ind AS, how were they dealt with? What was the detailed disclosure if there were some significant reversals of tax provisions of previous years? Even in terms of goodwill, on annual goodwill impairment test with assumptions. I'm not only saying compliance with that, but there are lot of significant insights which have been given. Ind AS 107, which requires liquidity disclosure, where risk disclosure for financial liability, which is optional, but the company also has included in the financial, along with the financial assets, a liquidity risk disclosure, which was optional. So there are many companies which have I would say have been early risers. They are early runners. They have put in a lot of efforts well before the year reporting starts in various aspects. And because you have to, in a very large company, you have to gather a lot of data, statistics, information. They have to talk to each other, and therefore what we find is that when the company puts in more information, qualitative information, which is not just boilerplate, I think it is a recipe for a customer's delight. And in conclusion, uh, it is the wish of the jury and of the research committee and of the shield panel members and every possible technical reviewer who will have an opportunity to review the March 21 accounts, that we have great competition where the everybody connected with the process has and are will fall in a dilemma that which shall we select, which is more superior compared to everything which is in a superior category. And I wish all the listeners the very best in the journey for producing what we would like to call an excellence in financial reporting. And with these words, thank you so much. Thank you so much, um, Chairman Sir, and the entire research committee for giving me an opportunity to present the learnings. Every time I have been part of the research committee as a part of a shield panel over the last several years, uh, my knowledge and my team's knowledge has only sharpened, and understanding of the of the standards and appreciation of all the companies which puts in hard work has only improved. And I salute all the winners in the past for putting a lot of efforts, and best wishes for the upcoming companies for their nomination and participation. Thank you so much.
Thank you, Sandeep sir, for your nice deliberation. Although I know this, for this topic, it's very short time to cover all these aspects, but you very precisely and very nicely you covered all the topic in given time frame. I know it is it, it's required a lot of time, but
Agravalji, I have another 70, 80 slides, but
yeah, I know, sir. I know, sir. For that, we planned because of this corona, we couldn't have this residential program. Otherwise, we could have a training for our technical viewers. We are planning for that. We are on the path to improve day by day at ICAI level. Also, we want to improve the whole system. We want to bring more transparency. We want to bring. I'm not telling that it's all transparent manner. All past efforts are very good. For future, we want to take further steps for each and every aspect. We want to bring more TRs. We want them to be more trained, more customized for this job, and we are including more number of shield panel members in our team. We have received so many queries with respect to administration and other things, but this session is not meant for all these things. The session is meant for how we can improve the efficiency and the effectiveness of financial statements. So I am taking few questions because we are running short of time. I'm taking few of the questions. I would request Speaker of the Day, Sandeep Sasar, kindly give quickly refer these questions. One is it possible this administrative issue again? The soft copy we will share with you with the permission of Honorable Speaker.
yes, please. Yes, of course, of course. This is, sir. This is the I would say the library of the research committee, sir. It is only y'all who have given us the opportunity to put this, sir.
Thank you, sir. Thank you, sir. One question is my MIES, MICE outstanding will fall under financial assets considering current scenario.
I'm sorry,
Sandeep sir, I will again repeat it. MIES outstanding.
MEI, the merchant export incentive scheme.
Yeah.
MEIS. Yes, MEIS. So like today, so they will fall under the financial asset category, sir.
As a current ratio?
No, this has to be classified under the financial asset category. Now, obviously, it is expected that this will be issued by the government well within the time. So, say obviously, this would be under the current asset category, but under the financial and not under a non-financial category.
Sir, another question is, in case of NBFC, if provision is taken as higher or expected credit loss, ECL, and as per RBI guideline, then how to incorporate this in the company's accounting policy?
So today the requirement is under ECL model, the company has to define its own ECL model, and therefore if the regulatory provision is greater, that's the RBI circular also says that you provide as an additional reconciliation between what does the RBI provisioning norms are and what is the ECL provision which is required, because the ECL standard does not say that ECL or regulatory provision, whichever is higher. Because you will take all inputs which are flowing from the regulator's requirement while looking at the ECL, but ECL has its own provisioning norms. So this can only be an additional requirement, and that is also what RBI is expecting. So during the RBI research paper, they have found that the companies which are having an ECL provision lower than the prudential norms, they are looking at as to how the company's entire model of determination of ECL is, and they are also accepting the position that it can be the case that you can have a ECL provision lower than the RBI norm for your Ind AS financial statements. But that's, and then thereafter RBI is also saying that you will give us an additional reconciliation.
Yes, sir. Another question is, effective interest.
So I may say, sir, that wherever the accounting policy said that you are taking higher of the two, those are the companies which are not treated as compliant with Ind AS 109 standards, sir.
Yes, sir. Another question is effective interest rate method not followed by some insurance companies, as Ind AS 109 is not yet applicable to them. Would it still tantamount to non-compliance of Ind AS?
Sir, insurance company, in any event, we are taking only Indian GAAP, sir. We are not applying Ind AS, sir. So even while insurance companies are participating, but with banks and insurance company categories, sir, we are looking at the Indian GAAP only, sir. So there our standards which we are applying are the Indian GAAP, sir, not Ind AS.
Yeah, so there are many questions, but more on administrative aspect. I would like grouping them in because similar nature of queries is received. For CPRs, it is a webinar, it's not a BCM. For CPRs, you go for unstructured CPRs process in your SSP portal. And for PPT, of course, we will be sharing. I would request CMHG to please take care of who is interested. Okay, please share the PPT with them. And many other administrative issues regarding inclusion of the shield panel member and other aspects. So members are kindly requested, please speak on myself or chairman. Wherever they have any suggestions, valuable suggestions are always welcomed. It will be incorporated wherever possible and wherever feasible. And so be rest assured, ICAI is there. It's a very reputed statutory body, and all the process is transparent. And we have a transparent 3-layer system in this award ceremony. So I think most of the things already covered. One new question received. As per Ind AS 108, para 34, do we need to include the revenue from group entities for determining 10% of revenue?
So if the company has taken the exemption from disclosing the operating segments at the SFS level, then obviously in the console under intra it will get knocked off. But if there is going to be a standalone disclosure plus, then obviously it is still a major customer whoever is within the group entity, right, sir?
Sir, one question is slide 19. MEIS is used for payment of custom duty on imported raw material. Then how it will be financial asset? Please clarify.
Sir, the script can be either sold or can be used. In either case, it represents cash.
Okay. One question is, insurance claim receivable will be financial asset?
Insurance, so here, sir, it will here again, because if it is not accepted and it is only merely a claim, because all insurance claims are subject matter of acceptance, and therefore only merely by raising a claim does not mean that there is a financial obligation on behalf of the insurance company. So it will depend on facts as to what is the stage at which that claim is there, sir.
Yeah. So thank you, sir. In absentia, I thank to my chairman and vice chairperson and whole committee secretary for their tedious task they have performed. And my many thanks to CA Sandeep Saji. Without his efforts and concern, I think it was not even possible to have this webinar. Whenever I stuck somewhere, I always used to call Sandeep sir for all these matters. And Sandeep sir, it's a humble request to you. Please bring more people, transform this knowledge, and have a bigger team. We have a bigger, because every year we are expecting more number of entries. Some SMEs is to be invited, because we are trying our level best to increase the number of these. And sir, we definitely we will be having more and more training programs, webinars. We will be trying our level best to increase this field in a higher side. With these words, thank you, sir. Thanks a lot.
Thank you, and again, I thank you, and I thank my team of Trupti Dubey, Nikunj, and Bhavin Kapade, my partner, for making this presentation for me. Thank you so much, sir. And
thank you, CA Prashant Jhaji, for your time and efforts. Thank you.
Thank you, sir.